days after the second May bank holiday, the pace steps up a little bit this week. We have two sets of macroeconomic data which might be worthy of your attention, one on each side of the Atlantic. Here in the UK, the big numbers to watch are the latest Purchasing Managers' Indices, or PMIs, from the manufacturing, construction and services industries on Monday the 3rd, Tuesday the 4th and Wednesday the 5th of June respectively. Remember that a reading above 50 is generally indicative of growth in that particular industry, while one below, well, that implies at least a slowdown or even a downturn in activity. So these surveys offer some insight into the trajectory of the UK economy and the earnings of those companies who are exposed to it. Just to remind you that in the readings for April, well, they were pretty mixed. Manufacturing weakened a little bit to 53.1, construction improved to 50.5, and services improved to 50.4. Meanwhile, over in America, we have the latest non-farm payrolls, unemployment rate and wage growth data, and they are all due from the Bureau for Labour Statistics on Friday the 7th of June. Now in April, America's economy added 263,000 jobs, way above the 12-month rolling average of 211,000. That took unemployment down to 3.6%, the lowest rate in 50 years, and that in turn took wage growth to 3.2% year on year, on an hourly basis, in case you're interested, to $27.27 on average. Now, we can see American unemployment and wage growth here. Wages are ticking up as the jobless rate ticks down, so perhaps the Phillips curve is not dead after all. But what still seems odd, at least to me, is how the US Federal Reserve is in anything but a rush to increase interest rates from the current 2.5% level, given how hot the jobs market seems to be running. The central bank is sticking to its plan to be patient, as it describes it, and according to the CME FedWatch tool, markets are putting in an 80% chance on a rate cut by December and a 1/3 chance of at least 2 reductions. So, either the Fed knows something we don't, or the markets could be in for a shock if they think the central bank has automatically got their back. We shall see. Company-wise, there's just one FTSE 100 firm with a scheduled announcement due this week, though there should be plenty of interesting information to be had from the following corporate results and trading updates further down the market cap rankings. On Tuesday the 4th, online electrical appliance retailer AO World will release its full year results. Biffa and Card Factory will release results, and Royal Dutch Shell, Babcock and Chemring will host analyst meetings on the 5th. Transport Group Go Ahead is scheduled to issue a trading update on the 6th, ahead of its potentially contentious annual general meeting, and Fuller Smith & Turner is set to release its full year results on Friday the 7th of June. However, for me, the stock most likely to cause a big fuss in the week ahead is Autotrader, when the FTSE 100 company publishes its full year results on Thursday the 6th of June. That's partly because it's the biggest of all the firms due to actually release results during the coming week, with its market cap of some £5.5 billion, but also partly because the first half results were so strong, and partly because Chief Executive Trevor Mather has announced in April that he will be stepping down from the job at the end of March 2020, when the company's current financial year draws to a close. As we can see here, the shares have really been on a roll in the past 12 months, and the cautionary comments about the second-hand car market that hit the shares in 2017, they now seem to be a bit of a distant memory. The company stopped printing its magazine back in 2013, in case you were wondering, and it's now purely online. It's got 3 key drivers for its revenues, and all of them will be analysed closely when the results come out, both for the year just ended and also given any forecasts for the year just beginning. The first indicator is stock. Physical stock on the site was down by 3% year on year to 437,000 vehicles in the first half, just as management had been predicting. Retailer forecourts were flat at just over 13,100 cars. The second factor to watch is price, and the third is product. The key here is to look for new offerings such as dealer finance and a new search service which could drive advertising. In the first half, for example, full page advert views rose 1% year on year to an average of 247 million a month. In terms of the headline numbers, consensus forecasts, well, they're looking for the following: a 7% increase in sales to £352 million, with a further 7% expected for the year just beginning to £375 million, a 9% increase in pre-tax profit to £230 million, with a further 10% gain seen in the new financial year to £252 million, and finally an 11% increase in the dividend to 6.52 pence a share. That equates to a yield of around 1.1%, which may not set income hunters' pulses racing, but since its 2015 flotation, Autotrader has increased its payouts, launched share buybacks and decreased its net debt pile all at the same time to suggest that underlying cash flow is robust. Thank you for watching, and I look forward to seeing you next time.